Stock options are another form of executive compensation. You can be granted the right to buy stock in your company at a certain price, and that right lasts for a certain period of time.
Stock options come in different formats. So the first thing or first action item you want to do if you're awarded a stock option is to understand what type of option you've been granted. There's a couple that we see consistently, which would be a non-qualified stock option, a stock appreciation right, or an incentive stock option. For purposes of our discussion today, we're going to focus on a non-qualified stock option and stock appreciation right, because those are, for the most part, what we see most frequently, and those have the same tax consequences. That's not to say an incentive stock option is any less valuable, it's just different, and we don't see it quite as frequently in our practice and in companies at large today.
So at the time they're granted, they typically aren't yet vested. A stock option will typically vest over a 4-year time period is common to what we see. 25% a year for 4 years till you're fully vested.
Also, options have a life period. So what does that mean? That means once you vest in the option, you have a certain period of time where you can exercise the option. In our practice, we typically see a 10-year option life, but we have seen other periods such as 7, 8. So it's important to know not only what type of option you've been awarded, but also your exercise life and vesting schedule.
So for example, let's say today your company stock is trading at $50 a share. You are granted a stock option today to buy a share of stock for $50, and you can exercise that right anytime over the next 10 years. So 2 years from now, 3 years from now, if your stock has gone to $100 a share, you have the right to buy it for $50 a share. At the time the stock option is granted, there's no tax consequences. It's at the time you decide to exercise the stock option that you generate ordinary income that is reflected on your W-2 at the end of the year. At the time you exercise, your employer will withhold appropriate federal income tax, state income tax, and FICA tax.
Most times in our practice, we actually see cashless exercise, which is where you elect when you exercise your option to receive cash proceeds. So not only are there shares withheld to pay the income taxes, the net after-tax shares are sold right away, immediately upon exercise, and you receive a cash deposit into your designated brokerage account. At that point in time, when the option is exercised and that amount of income then goes into your W-2, that's what starts your cost basis in that share value if you do in fact elect to continue to hold those shares. So it's important to understand at time of exercise that triggers ordinary income. If you choose to hold the net after-tax shares, which starts your cost basis for income tax reporting period, then that triggers or can translate into realizing future capital, a capital transaction, whether gain or loss, a capital income tax transaction. So what does that really all mean? Are there any strategies that we can, kind of walk through when we think about a stock option? And in fact, there are. With a lot of other executive benefits, you don't have a lot of planning. Like with a restricted stock award, you're granted the award and you don't have control over when that's going to vest and become taxable to you. With a stock option, you do, because the decision to exercise is yours and yours alone.
So what is an appropriate strategy for exercising stock options? Well, in a perfect world, exercising at assuming the stock is generally going up over the 10 years that you have to exercise, in a perfect world, exercising at the latest possible date at the highest possible market value is the best strategy. We don't live in a perfect world, so we typically recommend targeting years 7, 8, and 9 of a 10-year option life, for example, to exercise your stock options. You don't want to wait all the way till the very end, just in case, for some reason, the stock goes down in value and you don't have a lot of time to recover that value before the option expires.
What else can go into determining when does it make sense to exercise an option? Well, obviously, income tax rates. So if you're going to be in one tax bracket in year one and a different tax bracket year two, that's something to evaluate. Would you really want to accelerate exercising an option if all of a sudden income tax rates are going to change, either given your personal income tax situation or current income tax legislation? Other things that may warrant a review of whether or not it makes sense to exercise would be, do you have a need for the cash? Do you have an upcoming large cash outlay that you need, whether it be for maybe college, a wedding, a vacation home? There could be reasons why you'd want to accelerate. Then other things that come into play are just company characteristics. Are you working at a company that's kind of a slow growth company, or a company that has growth, that, you know, it's, I don't want to say safe, but more secure to wait until the later years of the option life? Or are you in a startup company where it would make sense to possibly accelerate because the company is going to be acquired? So as you can see from the discussion, there's not one answer that would dictate when to exercise an option, but several that you would want to discuss with your financial advisor.